Last week was nothing short of a financial roller coaster ride. As we navigate through this labyrinth of data and shifting narratives, it becomes increasingly evident that adaptability and foresight are paramount if you're going to have any success. The dominant storyline for more than a month has revolved around the Federal Reserve's potential to hike rates, igniting waves of uncertainty and market volatility. This was first put forth by some economists, including former Secretary of Treasury Larry Summers. Recent developments, including a reassuring tone from Fed Chair Jay Powell, have calmed some of those fears. During last week's FOMC press conference, Jay said the Fed does not see a rate hike as likely and believes they will achieve the goal of 2% inflation, albeit later than previously thought. Despite that positive tone, market sentiment remains on edge. Stocks rose throughout Powell's press conference, but during the final hour of trading, investors dumped that exposure, giving up a near 1.2% gain in the S&P. Risk assets respond to all sorts of data, but none more important than the risk-free rate. It is the first input of most valuation models. Markets will react violently when the perception of the terminal rate changes. So what changed on Friday that turned fears into cheers? Was it a better-than-expected report from Apple, or is bad news once again good news? Is the job market finally starting to cool, making the Fed's job a little easier? All tough questions. Let's get some answers. Welcome to The Money Runner. I'm David Nelson. The softer-than-expected 175,000 non-farm payroll number on Friday put in a bid for bonds and lifted stocks that just days earlier had been for sale. Mounting fears of slower growth and stubborn inflation were forcing investors to reduce equity exposure. This phenomenon, where bad news spurs market optimism, underscores the intricate dance between economic indicators and market sentiment. Fed fund futures have been wrong for most of the past year. At the start of the year, a rate cut in March was a lock, with markets pricing in a near 100% probability the Fed was about to take their foot off the brakes. 2 months later, we've seen Fed fund futures swing from no cuts this year to the current narrative that there's a 50-50 chance of a cut in September. Needless to say, the financial news cycle is fluid, and when and if they cut is a moving target and clearly data-dependent. Amidst this uncertainty, it is imperative to approach market projections with a measured perspective. As history has shown, relying solely on Fed rate predictions can be akin to chasing shadows. Instead, a more robust strategy entails scrutinizing earnings and economic data for sustained market support. Diversification beyond traditional U.S. markets is increasingly attractive in the current late cycle environment. Exploring opportunities in international markets and commodities can provide alternative income streams and mitigate portfolio risk. Year to date, many markets outside the U.S. are providing better returns. The one caveat is that the recent strength of the U.S. dollar has diluted the performance for U.S. investors. There are currency-hedged foreign market options one can explore. Themes like the rollout of AI and investments in the electric grid offer promising avenues for growth amid evolving market dynamics. It is clear that investors who embrace alternative energy solutions are returning to nuclear as an option. China currently has 55 plants in operation, 21 under construction, and more than 70 planned. artificial intelligence, and the increasing power demands of data centers will force the United States to embrace a proven power alternative that can meet that demand or risk falling behind a clear rival. There are plenty of investment options, but take a look at Global X Uranium ETF URA. The volatility is high, but it has trounced traditional stock ETFs over the last 5 years. Reliance on a handful of dominant players, dubbed the Magnificent Seven, underscores the need for broader market participation and a reevaluation of conventional investment approaches. The paradox is that currently the bulk of earnings growth for the S&P 500 is coming from these cash flow-rich giants. At the index level, the other 493 companies aren't yet providing enough economic output. However, embedded in that group are scores of companies with explosive top and bottom line growth that is recognized by fundamental investors willing to move beyond passive strategies. So what should we be looking for? Federal Reserve's messaging will pivot in response to evolving economic data, reinforcing the importance of staying attuned to market fundamentals. Geopolitical tensions, domestic political unrest, and the looming specter of the upcoming election introduce additional layers of uncertainty, risk, and with it, volatility. As financial stewards, it is incumbent upon us to navigate these turbulent waters with prudence and agility. Challenges abound, but so too do opportunities. Those willing to venture beyond conventional boundaries and move outside their comfort zone can capitalize on emerging trends and gain a competitive edge. That's it for this week. Don't forget to sign up at my Substack site for transcripts, charts, and articles. DCNelson123 at substack.com. And if you like today's pod, do us both a favor. Hit subscribe. They're both free. Thanks for joining. I'm David Nelson, and this is The Money Runner.